Welcome back, Michael. What's new at Sprung Investment Management?
We've expanded a little bit. We now have 5 CFAs, all with considerable amount of experience working under the Sprung umbrella. Performance-wise, actually, we've had a pretty good year, although that's quite variable because we have such a variety of clients with differing objectives and differing asset mixes and so on.
What's your outlook on equity markets for the remainder of 2016?
Well, I think we're going to be lucky to be flat to either plus or minus, say, a 5% range. Could be greater than that or lesser if anything major happens, but the North American markets have continued to plow ahead despite a lot of the more recent geopolitical and business risks that seem to be coming to the surface. I mean, I'm not just talking about Brexit and the South China Sea and what's happening in the Ukraine and Turkey, but terrorism in general is now affecting the markets. And still lingering behind all this, we have the problem with the Portugal, especially Italy, which has come to the forefront in more recent weeks, Greece, Spain. So all of that is affecting investors' state of mind. And at the same time, well, the North American markets have been going up so much, we've had the bond market sort of running in the other direction, as telling us that, looking forward, the outlook is not too good for growth. And so here we have markets that have gone up, and yet the bond market's trying to say that, well, don't expect future growth to be that robust. Since the financial crisis, the governments around the world have tried to keep things going through easy money, quantitative easing, low interest rates, negative interest rates. It's gotten to the point now where we have over $13 trillion of sovereign debt trading at negative interest rates around the world. So at some point this party's got to end, and when it does, it might not be that joyous an ending. But in the meantime, I think that more worrisome to investors is what we're seeing on the political front, and this was reflected partially in Brexit, and we're seeing it also in the United States in their election. And what we're seeing is the exploitation by politicians of people's unrest in the current environment. And they're exploiting it by blaming free trade and globalization and the things that have been of great benefit to world economies over the last 40, 50 years or so. What we've had, though, is developing economies. Certainly they have taken some manufacturing business away, but a lot of that has got to be reflected through technology. And nobody wants to point the finger at technology because I think, quite frankly, politicians realize you can't turn back the clock as far as technology goes. So they're exploiting people's fears through blaming things that in the long run might even be costlier in terms of the ability of the world to continue on with economic growth and stability. I think this is going to cause, as it plays out, a lot more volatility in the markets, and that's where value investors like ourselves try to take advantage of the opportunities as they are created in greater volatility and people worrying. Because as I was saying earlier, right now in North America, it's fairly hard for us to find a lot of things that we're quite confident in owning at current valuation levels. But should things break down a bit, there's a lot of things that we're watching that we would like to step in and purchase.
What's your outlook for the Canadian banking sector for 2016? Will any of them be cutting their dividends?
I do not see the possibility of any dividend cuts, particularly within the big 5 banks. What we're dealing with at the banks, the investors have been concerned over the last year, energy on the one front, as you were saying, also on the housing market in Canada and the accumulation, I guess, of household debt, which is reaching quite high levels, particularly relative to the U.S., where household debt to disposable income has gone down. But the banks today are very diversified operations, and they're going to take advantage of differing parts of their business throughout this. Even within energy, the banks are going to participate in the merger and acquisition activity that's going to take place in the oil patch, well, is taking place in the oil patch. And a lot of what that does is it also allows them to repackage loans that perhaps are heading towards non-performing into better entities that will perform and will pay back. So there's that side of it. And also with the greater volatility in the markets, they participate in the capital markets and should earn more in trading volumes. Also, we're seeing banks diversify more globally. CIBC, which had largely retrenched since the financial crisis, has now gone out and positioned itself more in the U.S. Of course, we've got the Bank of Nova Scotia, which has always been fairly internationally diversified. So to some extent, you have to look at these banks as a total entity, and all of them have differing mixes in these various businesses, and you have to pick your spots as to where you think the opportunities are going to be coming forward.
Are there any stocks that you like in the Canadian energy space at this time?
What we're looking for when we're looking for energy companies are the ones that are well capitalized, well managed, and that will take advantage of the current environment by picking off assets from the weaker sisters in the industry, and in the long run they'll be able to benefit. So in that regard, you've got Suncor, which we own a great deal of. It's probably the most eminent in the Canadian oil patch, and certainly the largest, which is well diversified both upstream and downstream. We've got Canadian Natural Resources, which we also like. If you want to be a little bit more adventuresome, I think one could even go and look at companies such as Encana, which has not participated on the most recent rise in oil as much as the other companies, but has been restructuring and I think is going to be a survivor in the industry. Within the smaller cap area, I think you have to be fairly careful and fairly choosy, and you should probably pick a basket of stocks. But I wouldn't discount looking at things like Advantage Oil and Gas. Be careful. Don't buy the really distressed companies, because even with the increase in oil that we've seen of late, it's probably just not enough to pull them entirely on side.
Do you have any opinion on gold, given its strong performance this year?
We don't tend to be directly exposed to gold, but what we do is we like to have maybe up to 5% as a top limit of exposure to gold. And that has served us very well this year, with the increase in the price of gold being reflected in the underlying operating companies. And I guess to diffuse some of the volatility there, I prefer to be positioned in, again, the well-financed, well-managed, more senior producers. Within that area, Goldcorp is probably our largest holding. Again, we've had a change of management within that company. I think they've sort of taken all the write-offs and so on that they can in light of the environment that they were in, and they are well positioned as production increases going forward. They're a low-cost producer and they should do well. Perhaps the most outstanding example of a comeback has been Barrick Resources, but again, that is probably a bit more for the more speculative investor, but you really have to give management credit for keeping this company not alive, and I think they are restructuring it over time, and given the stronger prices we're seeing in the commodity today, it is likely to be a survivor, and it probably still has a bit more torque in it.
Are there any names that you like in this space?
One that we like is AGT, which used to be Alliance Grain Traders. They're one of the larger providers of pulses around the world. So we're talking lentils, chickpeas, all sorts of things. And this happens to be the year of the pulse, according to some international body out there. So they've had a lot more reflecting on them. Now that stock, which a few years ago was trading well under $20, got as high as 42 not too long ago. But it's pulled back a little bit because I think people are looking for somewhat of a lower crop in the current quarter, and hence there's been lesser volumes. So I believe that'll probably rectify itself going into the fall harvest. And beyond that, the company is expanding very rapidly into more ingredients made from pulses and so on. And there is growing demand globally for these items, and I think the company will participate. So at current prices, I think this is one that investors can look at.
Are there any other stocks that you like at this time?
If one wants to, again, be a little farther out on the risk-reward spectrum, I think you can seriously look at Stuart Olson today. Now, here's a company that's been held back largely because it's principally an Alberta company. A few years ago, it ran into trouble with some contracts that went way over in terms of budget, and they were fixed-price contracts. Management has since realigned that company, and it has been hurt recently by the slowdown in some of their activities, which were caused by the fires in Fort McMurray. So here you've had a company that's really not participated, say, with the SNCs and the ACONs, and it's a much smaller entity, but I believe with the infrastructure spending that they're planning to do, not only in Alberta but elsewhere, that an engineering construction company like this one will probably do well and prosper. So that is one that I think people can look at.
As always, great to see you, Michael. Thanks for taking the time for this interview.
Thank you very much.